Trading options. Although option orders are submitted to an option exchange, option buyers and sellers are not trading calls and puts with the exchange itself. Rather, they are trading with other option buyers and sellers, just as in the stock market. Option exchanges are merely marketplaces for buyers and sellers to meet for the purposes of trading. Once both sides have agreed on a price, a trade takes place. Call put holder is long the contract. An equity call or put holder who has purchased the right to buy for a call or sell for a put underlying shares is said to be long that option and is commonly referred to as the option's buyer. The cash amount paid to the option is non-refundable. Equity call option. Right to buy 100 underlying shares at the strike price per share. Equity put option. Right to sell 100 underlying shares at the strike price per share. Who actually gives an option holder the right to buy or sell stock? That's a very good question. It's not the company who issued the underlying stock. It's not the exchange on which the buyer purchased the option either. Instead, it is the option writer. Let's take another look at calls and puts from the writer's point of view. Long. The term long is not unique to options. An investor who has bought and owned stock is long those shares. The term long can also refer to a bullish position that will profit from an increase in either the price of an individual stock or the level of the market in general, as measured by a broad-based stock index. Writing an equity call. An equity call option is a contract which gives its writer the obligation to sell 100 shares of its underlying stock at the strike price per share at any time on or before its expiration date if called upon to do so. XYZ June 50 call. The writer of this call contract has the obligation to sell 100 shares of XYZ stock at $50 per share on or before its expiration date in June, if called upon to do so. Writing an equity put. An equity put option is a contract which gives its writer the obligation to buy 100 shares of its underlying stock at the strike price per share at any time on or before its expiration date, if called upon to do so. XYZ June 50 put. The writer of this put contract has the obligation to buy 100 shares of XYZ stock at $50 per share on or before its expiration date in June, if called upon to do so. Who writes contracts? That's another good question. Basically, anybody can write a contract. This is not by any means something only option professionals do. Equity call and put contracts are often written by individual investors like you, with the approval of your brokerage firm. At the beginning of this class, we covered some of the motivations you might have for using equity options. Two of these motivations were, you can prepare to buy stock at a lower price, you can generate income against current stock positions, supplemental to any dividends paid. Some of the option strategies frequently used by investors to achieve these goals involve writing option contracts. How to write an equity option contract. I understand that call and put writers have obligations, as you just discussed, but how would I write a contract? You just learned that option writers grant option holders the rights conveyed in the long call or put contracts they've bought. So let's look at how that is done. In the options marketplace, that is to say, on an exchange, you sell a contract that you don't actually own. How to write an equity option contract. In the stock market, investors and professional traders frequently sell shares they don't own. These are called short sales, and they result in short stock positions. A short seller borrows the shares from someone else and sells them to a buyer in the stock market. The short seller is then obligated to return the borrowed shares to the lender, and so ultimately must buy them in the open market in order to do so. The mechanics of all of this is beyond the scope of this course. The point to be made here, however, is that selling a security you don't own is not an entirely unusual concept. In the option marketplace, you write an equity call or put contract by selling one you don't actually own. In other words, you're not currently a holder and long that call or put. Unlike a short sale of stock, you don't borrow a contract to sell. Instead, you are in a sense creating a new option contract by selling the right to buy 100 underlying shares for a call or sell 100 underlying shares for a put to an option buyer. In turn, you are being paid to take on the obligation of a call or put contract writer that we discussed earlier. Call put writer is short the contract. An equity call or put writer who has sold the right to buy for a call or sell for a put underlying shares to someone else is said to be short that option. The writer keeps the cash amount received, whether called upon to fulfill an obligation or not. Writer-seller is short the contract. Equity call option, obligation to sell 100 underlying shares at the strike price per share if called upon to do so. Equity put option, obligation to buy 100 underlying shares at the strike price per share if called upon to do so. Short. The term short can also refer to a bearish position that will profit from a decrease in either the price of an individual stock or the level of the market in general, as measured by a broad-based stock index. Points to remember. An equity call option is a contract that gives its holder the right to buy, writer the obligation to sell if called upon to do so, 100 shares of underlying stock at the strike price per share at any time on or before its expiration date. An equity put option is a contract that gives its holder the right to sell, writer the obligation to buy, if called upon to do so, 100 shares of underlying stock at the strike price per share at any time on or before its expiration date. An option holder is long that option contract. An option writer is short that option contract. The total cash amount paid or received in the marketplace for a call or a put is called the premium. Think of premium as the cost you might pay for another type of contract, like a policy to insure your house or automobile. At the end of this lesson, you will be able to define premium paid or received for an equity option, calculate premium paid or received for an equity option, describe a debit versus a credit transaction, premium quoted per underlying share. As you know, when you buy stock, its price is quoted per share. If the price is $50, you buy one share, you'll pay $50. If you buy 100 shares of the same stock at the same price, the amount you'll pay for all the shares is $50 times 100 shares, or a total of $5,000. Option prices in the marketplace are quoted in dollars and cents per underlying share. But remember, the standardized unit of trade for an equity call or put is 100 shares of underlying stock, or the number of shares that will change hands after the option is exercised. Therefore, the total premium cash paid or received for any option transaction in the marketplace will be the quoted price per share times 100 shares, or simply 100 times the quoted price. In this regard, 100 is the option's premium multiplier. Price versus premium. An option's price is set by buyers and sellers on an exchange and is publicly quoted in dollars and cents, e.g. $2.50 per underlying share. The total amount of cash you pay or receive after an option transaction, or the quoted price per share, times 100, e.g. $250, is properly termed the premium, not including commissions. Buying a call or put. I've found an equity option in the marketplace with a quoted price of $3.50. What's my total cost for buying it? Remember our formula for calculating premium amount: quoted price times 100 multiplier equals total premium paid or received per call or put option. If the option is a call priced at $3.50, the total premium amount you'd pay would be $3.50 times 100 multiplier equals $350 total premium paid per call. If the option is a put, also priced at $3.50, the total premium amount you paid would be the same. $3.50 times 100 multiplier equals $3.50 total premium paid per put. Selling or writing a call or put. Okay, I've got that. What if I've found an option in the marketplace with a quoted price of $350? What's the total amount I'd receive for selling it? The same formula for calculating premium amount applies. Quoted price times 100 multiplier equals total premium paid or received per call or put option. If the option is a call priced at $3.50, the total premium amount you'd receive would be $3.50 times 100 multiplier equals $350. Total premium received per call. If the option is a put, also priced at $3.50, the total premium amount you'd receive would be the same. $3.50 times 100 multiplier equals $350. Total premium received per put. Selling or writing a call or put. Does it matter whether I sell a long call or put contract I've purchased as opposed to a short contract I'm writing? Would I receive the same amount of premium? Yeah, you'd receive the same amount. $350 in the examples above. In the marketplace, the person who buys an option contract from you does not know whether you're writing that contract or selling one that you previously purchased and are holding in your brokerage account. Debit versus credit transactions. When you buy a call or put option contract, the total premium amount you pay for it will be debited or transferred out of your brokerage account. For this reason, buying an option is called a debit transaction. On the other hand, whenever you sell or write a call or put option, you'll receive premium with the total premium amount credited or deposited into your account. Therefore, selling an option is called a credit transaction. An example of debit and credit transactions can also be found on your bank statements. When you withdraw any money or when checks you've written have cleared, these activities appear as debit transactions. Cash is leaving your account. All of your deposits appear as credit transactions. Cash is going into your account. Equity option premium. I understand the meaning of the words and credit, so this makes sense. But all this sounds like an accounting matter. What does it have to do with learning about options? You're right. These are issues your brokerage firm is concerned with each time you buy and sell any financial instrument. But you'll see and hear the terms debit and credit used frequently, although in a slightly different sense when you're introduced to many of the more complex option strategies frequently used by investors. This is a good time to include them in your options vocabulary. Points to remember. Equity options are priced in the marketplace in dollars and cents per underlying share. The total cash amount paid or received in the marketplace for a call or a put is called the premium, and it is calculated as quoted price times 100 multiplier equals total premium amount.